Broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains, here for our once every 3 weeks Investors Observer members only workshop. Welcome. Thank you for coming. Let's get a look at our agenda. It's pretty much the same as usual. We'll look at some charts. We'll talk about what else is happening in the economy. We'll look at sectors and industries that are hot right now, and then the rest is member-driven content. We only got, I think, 1 or 2 questions ahead of time this time, so there's plenty of time for questions. You can go ahead and put them in now if you came with a question today. If a question comes to you while I'm talking, you can also put it in the question box, and we'll get plenty of time for that. If you do send in a question ahead of time, I can make slides about it. I've pulled charts before, done stuff like that. You get probably a little bit more thoughtful answer, but I'm happy to answer things in the moment as well. All right, let's look at some charts. Okay, so the S&P 500. Last time we talked, we were, I don't know, somewhere in this area. Things are looking better since then. We talked last time about seeing higher lows. We've also seen some higher highs in terms of here and then here and then here. And then today we've got a little bit of a breakout above this level, and also I pulled this chart a little earlier, so this price isn't exactly right, but we did close above 4,200 today, which is a big round number, which can also serve as either support or resistance depending on which direction you're going. So all that generally looks pretty good, just from a technical perspective. Some of the other indices are not quite as good. The Nasdaq hasn't been quite as strong, and I didn't get a great capture on today's candle because I had to pull these charts before the close. But it still doesn't look bad necessarily. We got higher highs, still moving up. There's not really anything to worry about here as far as that goes. The small caps, the Russell 2000. Again, this has been sort of the weakest of the major indices for the last probably several years, really. But it has come back probably better than anyone else in terms of being pretty strong here. So that's also kind of nice to see. So the S&P 500 versus the equal weight. Again, what we see here is these are tracking relatively close together, which means that the big tech companies are not sort of powering the gains, right? At the turn of the year, you see the separation. The S&P 500 is in blue and the equal weight is in the candlesticks. Right, that's because a lot of the gains last year were in those big 5 tech stocks that are at the top of the S&P 500. And then a lot of the losses at the beginning of the year were also in those big 5 tech stocks, and that's why the blue line goes underneath the candlesticks here. But coming back here, we're tracking pretty close together, which is, I think, good. It means everything is kind of moving up at the same time. We don't have a lot of distortions or dislocations or money all flowing into one place, which is typically not something that's sustainable over any sort of long term. All right, growth versus value. Value remains the top performer over the past year. Although, growth has been stronger over the last month or so, since that sort of bottom in June. They both seem to have bottomed at the same time, but the value stocks just haven't put on as much as the growth stocks. And this is generally what you'd expect, right? Like growth stocks go up faster, but they also tend to be more volatile and more prone to downturns, when those come around. All right, sectors and industries that are hot right now. First, let me show you where you can find this on the website. It is stocks and then sector and industry. And you can actually see these ranked by any of our scores. I like to use the short-term technical score because that looks back to see kind of what's been hot over the last month or so. But certainly if you're looking for value plays or things that the market is really into today, you can look at, the valuation, the analyst ranking, sentiment, however it is that you want to slice it, you can do that. And then if you click through on one of the sectors, you can get the full list of industries in that sector. over here on the right, as well as the companies rated by whatever that score is. All right, so back to what the scores or the sectors actually are. Energy remains at the top with thermal coal, which again, this is a little bit of an anomaly because thermal coal is a pretty small industry. There aren't a lot of big companies there. But with natural gas shortages and oil shortages places, it turns out it's just a lot easier to put coal on boats and ship it across the ocean from the U.S. Or other parts of the world than it is natural gas. There are a few what they call gas liquefaction facilities, and we're building more, but they're all pretty much running at capacity, and it takes a lot of money and a lot of time to get those things set up, whereas we've been exporting coal for a long time. It's not hard. But that is basically, the mining of coal used for power. There's a metallurgical coal, I think, is the sector for the coal that's used in steel production. Oil and gas midstream, this tends to be like refiners, pipelines, some things like that. Companies that move oil and gas around. That's not really surprising. The actual price of oil has fallen back a little bit, as has the price of gasoline and the retail products that are derived from it. As we typically see, though, what's happened is the price of oil is actually falling a little bit more than the retail products. And so the difference between those things, right, like the difference between what a refiner buys a barrel of oil for versus what they sell, all the various component things that they get out of it after they break it down, is called the crack spread, and that has been relatively wider as prices have been falling, which the crack spread tends to be wide, especially when oil prices are going down, because gas stations and refiners tend to keep prices high as long as they can. And then, drilling remains relatively high. And the drilling here is not like your Exxons and your Chevrons. It's smaller companies, mostly in the U.S., who are specifically drillers. It's not the big integrated players. That's a different industry. So this is, essentially what it looks like when people are betting that onshore production in the U.S. is going to ramp up, as these smaller drilling companies their stocks tend to do well. Utilities is next, which is kind of interesting because utilities is not really a particularly exciting sector. It is, however, the sort of place where people put money if they're worried about a recession. So I think that's probably what's going on here. You got independent power producers and then regulated electric and unregulated gas. Those are the last bills that people tend to stop paying after, I guess they maybe let those slide before they let the rent slide, because you don't need to heat a house you're not in. But, if you're really worried about a recession, these are handy places to put money. Also, if you're worried about just market volatility, most of the utilities pay a dividend of some description. The stocks never go up a whole lot real fast, but they're pretty stable and they do pay that dividend. Real estate was new to the list this time around. Went from off the list to on the list. Hotel and motel, retail, and specialty REITs. Some of this is after earnings, right? Like Hyatt and some of the other hotel operators reported good earnings. That means that the hotel and motel space is doing well. And then, retail and specialty, the consumer spending remains pretty strong. Specialty REITs would probably better be described as like a mixed REIT. They tend to have a lot of different kinds of properties, and they don't fit into one of these other buckets. Industrials, also new to the list this time through. Infrastructure operations, which is the kind of companies that operate ports and things like that. Bridges, companies that maybe do a lot of paving, things like that. Airports and air services, and uranium. The first two of those are obviously, sort of supply chain things. Logistics remains an important issue. We'll talk about that a little bit later in terms of how companies are dealing with the supply chain shocks we've seen over the last year or two. And then uranium, I think there was an expectation that some number of nuclear power plants in Europe were going to close relatively soon. And now it seems like they're probably going to stay open longer than expected. It's also possible we'll get some new ones, although no nuclear power plant has been built in the United States for, I feel like, 30 years or more. And it would be sort of interesting to see that happen here. But, more plants staying open longer in Europe and maybe more plants staying open longer here would certainly increase sort of future demand over, some baseline that assumes those plants are going to close. And then finally, consumer defensive, still in that fifth spot there. Confections, food distribution, grocery stores. All of those are basically groceries. And that's, again, it's a little bit, as the name of the sector implies, it's a bit of a defensive play in the sense of, what are things that people spend money on in a recession? Food, right? It's a thing you have to do. Also, prices are going up. The grocery stores did relatively well. A thing about the grocery store is if you can pass prices on to customers, right? If you're selling something for $1 and you had a 2% margin, you get 2 cents every time you sell that. If you sell it for $1.10 and you have a 2% margin, you get 2 cents plus a little bit every time you sell that. So, if you can pass those costs on to customers, your actual earnings in dollar terms go up, as prices inflate. So it's a little bit of all of those things happening there. All right. What else is going on in the economy? Interest rates, inflation, the Federal Reserve. This remains kind of the driver of what's going on in the market. The inflation report, the CPI, came in better than expected this morning. And so stocks went up. But generally, I think sort of no one knows what the Fed is going to do at the next meeting, including potentially members of the Fed board. They're all saying relatively hawkish things that aren't particularly specific. The inflation data, like I said, was better than expected this morning. But the economic data is also giving the Fed more room to raise rates if they want to, right? The job market continues to look pretty strong. Financial conditions are actually loosening in the sense that bond yields are going down, stocks are going up. Those are loosening financial conditions, which is kind of the opposite of what the Fed is trying to achieve to get inflation in check. And generally, a lot of the prices that are falling have been energy prices, which obviously is an input in everything. But that big drop in energy prices may be sort of temporary, as we might see some surge in the wintertime as global demand for things goes back up because it gets cold in the northern hemisphere. The next thing that people are still talking about, although it's less, it seems, the last week or two, is recession. We had 2 quarters of negative GDP. However, if you look at things like the job market, consumer spending, various other indicators throughout the economy, they point to a relatively strong economy. Certainly 2 quarters of negative GDP has sort of been a back of the envelope way to determine a recession. However, a recession where the economy adds several million jobs, consumer spending remains strong, things like that, it seems like it makes the word recession less useful. So you can call it a recession if you want, but it's certainly not equal to a bunch of other recessions we've had recently. And so, again, you can call it what you want. I think it's a very different recession if it is a recession. There's been some talk recently in econ circles of labor hoarding, which is essentially companies maintaining or holding on to staff when they might otherwise lay them off. And this is, I think, a reaction to what happened after the pandemic shock, when a lot of people got laid off very quickly and then companies couldn't hire fast enough. This, I think, suggests an expectation from a relatively quick recovery from any weakness in the economy. And there's also, I think, some signs of some regular hoarding happening, one of the lessons of the supply chain crisis is to have slightly more reserves of things you need. We spent a lot of time shifting the economy to sort of a, just enough, just in time kind of model. But it turns out that that really just moves risk to from one part of the system to another, right? So a retailer may not want to have a bunch of inventory because it costs money. They have to pay to store it. Consumer tastes might change and they're stuck with a bunch of stuff they can't sell. However, the other side of that is they do have stuff to sell, whereas if you have just enough stuff delivered just in time to sell it, and something happens and your stuff doesn't get there, now you have nothing to sell. So it's just kind of shifting some risks around, probably a little bit of a moderation from what we've seen over the last couple decades in terms of how companies have dealt with things like that. Both of those things, labor hoarding, being overstaffed, and having bigger inventories, does make companies somewhat less profitable, sort of at the peak, but it tends to make them more resilient. So it's probably kind of a wash over time. In absolute terms, it may make things better. It certainly makes the entire system better because you're removing some fragility. You're sacrificing a little bit of sort of peak performance in exchange for less fragility, which is, probably good. Also, I saw an analyst note this morning that talked about the question now is whether the Fed can engineer a hard landing or a soft hard landing. Certainly hard landing versus soft landing are things that seem pretty subjective. And then, this gradation of hard landing versus soft hard landing seems to be really just kind of silly. Obviously, they're talking about, how deep any potential economic downturn could be. But, all of this suggests to me that people maybe don't have a lot of insight into what's happening, but feel like they have to say something. And so, right, like a lot of it is just kind of, speculation and guesses. And much like the recession talk, really kind of depends about like how you want to measure and define things. We're mostly through the big earnings. There's still a lot of earnings coming out every day, but most of the big companies have reported. Earnings were mostly good, better than expected. However, lots of companies had lowered the bar. The ones that are providing, there's fewer companies providing forward guidance now than there were pre-pandemic, but a lot of the ones that had kind of lowered the bar to some degree, so it wasn't super hard to do better than expected. And I think that's borne out by the fact that I believe the beat rate was slightly higher in terms of slightly more companies than normal beat those expectations. There were some places that cut guidance. Chip makers, I think, is maybe a big one. But I think what's happening there is one of the things that frequently happens, especially when you get shortages, is people overorder. So if I'm running some kind of business and I need some supply and I call up my regular supplier and they say, oh yeah, we don't have that, I might try to put an order in there and then put an order in at somebody else that makes the same thing and just see who can deliver it faster. But then when one order comes in, I'll go and cancel the other one. And so I think some of the demand that chip makers like Micron, I know, cut their guidance earlier this week. I think some of it is some of that over ordering. It gets very hard to know what the actual backlog is when things like that happen. All right, so we only got one question. I guess it's really two questions this time around, but they're both good questions. So from Kenneth, how do I get started and how do I watch the stocks that I buy? So I broke this up into two pieces. First, getting started, right, like just buy an index fund, right? Like it's safe, as safe as you can be in terms of investing in the stock market. It's instant diversification. You're guaranteed to get basically the same return as the overall market. That's a good thing to do, and it gives you an excuse to look at the stock market every day. You can learn some things like that. So that's what I think probably everybody who's just getting started at investing should do. Right, like just buy an index fund, right? The SPY, I think the Vanguard version is VOO, but something like that. And then I think in terms of buying individual stocks, what do you like or what are you interested in, right? But also start small and don't invest money you can't afford to lose. That's sort of universal in investing, but especially if you're going to start buying individual stocks. Individual stocks are much more volatile than your index fund. You may, see on the news or see your index fund went up or down. A big move is 2% in a day. Depending on your stock, a 1 or 2% move is much less surprising. And so things move around a lot. So what you're really trying to do is sort of figure out how the market works. You want to get a feel for things. But yeah, find something you like, find something you're interested in, figure out why you think something might be, some company might be bigger in the future than it is now. And that's a good place to start. But also figure out a strategy and your goals. Like, why are you investing? Are you, right? Like, did you recently give up golf and you have some time? If you're just investing to play around in the market, that's a very different strategy than I've decided to become a professional trader. That's a little bit weird to be a thing that you just decide without knowing how to get started, but I suppose it could happen. But it's also different from I want to retire early, or I want to pay for somebody's college, or something like that. And the next thing you need to think about is when you'll need the money. If you're trying to save some money for something you're going to buy in 1 to 5 years, your strategy is going to be different than, if you're in your 20s and you're trying to save for an early, because you want to retire at 50, right? Like if you have 30 years to invest, you can take a little bit more risk and probably have that pay off. Whereas if you're going to need the money sooner, you maybe don't want to put as much risk in there. And then the next thing is, how much time do you want to spend? Do you want to spend a couple hours a day, in front of the computer, making trades and managing things? Or do you want to kind of check in periodically once a week or so to keep an eye on things, or maybe even less? I have retirement accounts that I look at. Well, I look at them fairly often. I actually do anything pretty rarely. 3 or 4 times a year is most of what I'm trading, because it's full of index funds and I'm just rebalancing things. So that's how I would get started. Now, how do you monitor a portfolio? Remember the things that we just talked about. What are your goals in your plan, right? And then go through the things in your portfolio and think about, do these things still line up, right? Why did I buy this stock? Do I still believe the things that are the reasons I bought the stock? If you don't, then maybe think about not having that stock anymore. Also, risk allocation. If you hit a home run and you have a stock that's up really huge, good job, but you haven't actually made any gains until you sell it, because the stock can still go down. So consider trimming those large risky positions and putting some of those profits into safer assets that probably didn't go up as much. Take some money off the table and put it in your, that index fund, or find another stock and spread the money around, something like that. And then also periodic rebalancing. Even without home runs, your initial sort of allocation of money into some number of baskets will change over time. And so, yeah, you're going to want to essentially sort of rebalance, move that money back around, maybe spread it out more if you're trying to put together a big portfolio of single stocks. And then yeah, remember also to cut your losses. If the reason you bought a stock are no longer valid, sell it. Holding on to things for sentimental reasons or some other thing doesn't do you any good. And as human beings, one thing that's very difficult is admitting when we're wrong. But in a case like this, where being wrong is literally costing you money, it's important to try to have some discipline there. And do that. But that's basically how you go through. Just go through each position in your portfolio and say, hey, why did I buy this? Is that still true? Is this has this thing become an outsized position in my portfolio? Those are the big ones. And then, with the things that are losing, you don't want to just let things bleed. Typically when something's bleeding, people try to stop the bleeding. And in the case of a stock that's going down, a lot of times what that means is sell it. Yeah. All right. So that is all the questions we had ahead of time. Let's get to the questions. I see the box is filling up here, and that's good. Let's get to the questions that people have sent in so far. So Tom said, is copper a good sector right now, given the focus on energy and electrification? That's kind of a good question. If you look at, let's see, some copper mining companies, they're not doing super well right now. Now, some of that might be that this boom here was a little bit overstated. This run from here to here is pretty steep, as a lot of times happen in markets. The sort of correct price, if you want to call it that, is typically not the low or the high. I've heard people say that they expect the copper market to remain tight over time. So really, I think what it depends on is what is the meaning of the words right now in your question. Do you mean, is it a good thing to think about right now because it will be higher at the end of the year? I really couldn't tell you. Commodities are volatile, and there's all kinds of weird stuff that happens. But over a longer term, it's going to be very hard to electrify anything without copper. I heard someone talking recently, and they described us as being prisoners of the periodic table, specifically in regard to copper. And I think that's true, right? Like, we're just not going to electrify things without copper. There's going to be more copper in a lot of things if we keep going down the road of electrification, which it seems like we're going to. And it takes a while to get a copper mine stood up. So, again, it really depends on your horizon. It seems like a good story that could go for a while, but commodities also tend to be somewhat volatile. So for this year, who knows? For a longer term, it does, I think, seem like probably a pretty good idea. All right, so Charles says, what would normally happen if we held the IBM vertical bull put spread in the vertical spreads portfolio to expiration, and at expiration IBM is priced between 130 and 131, which is very possible. It seems to be a high risk being assigned the short leg. All right, so he's asking about a question that's in one of our options portfolios here. This position here specifically. We can go look at IBM. Well, the price is right here. Yeah, so IBM is at 131.63. And yeah, we have a 131, 130 spread here. So if the stock is between the two strikes, essentially the short put would be assigned at expiration. And what happens is the stock is put to us at the strike price, which means we would buy the stock for 131. You can then turn around and sell it for, whatever the market price is. Hopefully it doesn't fall off a cliff over the weekend, which would be pretty weird for something like IBM. I'm not sure what it would take for that to happen, but it is, I suppose, possible. And so you're out, in most cases, less than $1 per share. If it's below both strike prices, then you're out exactly $1 per share, except we made 30 cents in credit up front, so you're really only out $70 per share. So the break-even stock price for IBM on this trade is going to be like 130.70. Above that, assuming you can sell the stock, you make the full profit, or you make something less than 70. Below that, you make, some loss up to 70 cents, which is where 130 comes in. But yeah, the way we're going to handle this is we keep a close eye on it, and if it seems more likely to be below 131 than above it on Friday, the next 2 days we're going to be watching it pretty closely, and we'll close it and send you an email to say, hey, close this up for whatever the market price seems to be at the time. All right, so I have a question from Joseph. He says, if the markets continue to go down in the near future, is it worth selling all positions and getting back in later, or staying in the market and keep receiving dividends over the long term? So, well, let's go back to my slides here, first of all. The market's been going up since like the middle of June. That's the S&P. That's the Nasdaq, bottomed about the same time. Small caps, again, up quite a bit since the middle of June. So I'm kind of going to argue a little bit with the idea of continue to go down, because we've been going up for like a month now, which is, obviously not forever. We're obviously still down for the year. But, that's, yeah, right? Like I say, if they start going down again, maybe. But then, yeah, is it worth selling all your positions and getting back in later? That's a great idea if you can call the bottom. But let's go look at the S&P 500 here. I'll just use the ETF as shorthand. But right, the S&P 500 bottomed on March 16th in 2020. That was like 2 or 3 weeks after everything shut down. Nobody thought we were out of the woods, and a ton of people said, oh, this is a bear market rally. People were saying it was a bear market rally all the way to new all-time highs. So, yeah, I typically don't think selling all your positions to get back in later is really worth it. If you think we have further to fall, maybe hold on to those dividends and redeploy them when we're lower, something like that. But yeah, I don't think selling all your stocks is ever a good idea. Because your ability to call that bottom seems relatively unlikely. All right, so Ahmad says, I had about 30 shares of DD. Do you recommend keeping it? Yeah, so what's going to happen here is your shares are going to get transferred to, I believe, the Hong Kong Stock Exchange. Or maybe that already happened. I haven't been following this super closely, I have to admit. Yeah. So there's that. Let's see if we can still get news at the old ticker symbol. No. Okay. Yeah, so DD delisted in the US, so this is an ADR that trades, I think, over the counter. Yeah, so your shares got changed from DD to DDY. Yeah, I've talked about this at some length previously. The way all of these companies work is, right, there is a company in mainland China that has typically some contractual relationship or some maybe partial ownership in Hong Kong. And then frequently there is a company in like the Cayman Islands or something that owns that Hong Kong subsidiary, and that's the shares that people are buying here in the US. So it's kind of an interesting structure that was designed specifically to sort of skirt laws in China. And unlike in the US where we have like a legislature and people have to vote on things, that's not how things work in China. They can just say, oh, hey, cool, you found a loophole to get around these rules. Well, that's closed now. Deal with it. And that's basically what happened to Didi. They were told not to IPO in the US, and they did it anyway. And so, yes, you nominally, as an equity owner in this thing, nominally have some claim on the future earnings of this company. However, I think what you have to ask yourself is, do you think the Chinese government that just punished this company for holding an IPO in the United States at all is ever going to let earnings of the company flow out of mainland China to you, an investor who, is in the American markets, if not, presumably American? That seems pretty unlikely to me. I have relatively small exposure to anything in China for that reason. Just because, right, China's a communist country. They have some amount of, something resembling capitalism in terms of having markets and things like that, but they're generally controlled in a way that benefits the Chinese Communist Party. And I can't make up a story to tell myself where money flowing from essentially Chinese consumers to American investors actually benefits the Chinese Communist Party. So, yeah, I mean, could Didi go up from here? It could if a bunch of people decide to buy it, but at this point, I think this thing is kind of a dead issue. A lot of people have started holding the Hong Kong sub instead of the US sub, but again, I'm not sure you're ever going to see any actual dividends or other earnings flowing out of China to shareholders. All right, so William says, what about American lithium companies? Lithium is another thing that we're going to need a lot of if we're going to electrify things. Lithium batteries are the best battery we have invented so far in terms of how fast they charge, how much power you can put in a certain amount of battery. It's also relatively more stable than, say, lead acid or some of those other kinds of batteries. So yeah, lithium is certainly going to be an important commodity. And the, what are they calling it? The Inflation Reduction Act or whatever that just passed. Some of the electric car subsidies in there are only for companies that have battery suppliers that are either in the U.S. or sourced from companies that the U.S. has free trade agreements with. Now, I don't know if that applies to like actual raw lithium or not. But the thing about American lithium companies is there's a lot of them and they're all tiny. I think Albemarle is the one relatively big one that's been around for a while. There's a lot of smaller ones that have popped up in the US recently. And the thing that concerns me there, and the thing that I would do, is you can go to the SEC's website. And here, I can even throw this link in the chat. Yeah, so that'll take you right to this page. You can put in the ticker symbol of the company, and then you can go look at their filings. What I would do is I would find, let's just use Albemarle as an example. We won't find what I'm looking for here, but that's because Albemarle's big and they've been around forever. Look for a 10Q or a 10K. Those are the big quarterly filings. And one, look for revenue. Revenue is typically a thing you want in a company that you're buying. But then also typically there will be some commentary. Here we go. Here's a note about some litigation. But also sometimes you'll see a whole long list of name changes, especially with the smaller companies that maybe trade OTC. And so, yeah, if you're lithium company, I'm making air quotes that you can't see. If your lithium company was some other kind of company fairly recently, I'd maybe be skeptical about that. Also, if they're not currently operating a working lithium mine, I'd be somewhat skeptical about that. And I don't remember the tickers of these things offhand, but every time I saw it with rare earth metals, I don't know, more than 10 years ago now, fracking, there were a ton of companies that had new ways to extract oil that came out. A bunch of them turned into marijuana companies. A bunch of companies rushed into the Bitcoin space when that became hot. So, especially the real small OTC stuff, go look and see if there's a history of name changes, see if they have revenue from the business they're nominally claiming to be in, before you invest in those. I think basically the same thing I said earlier about copper is probably true about lithium. It seems like it's going to be somewhat difficult to get where people seem to think we want to go. Without a lot of lithium, but the individual companies, there are in particular in the lithium space a lot of things that seem kind of shady there. So I would be cautious of those. Right, so Mark wants to know about Comcast. So Comcast is somewhat interesting. It's hard to know how to classify Comcast. I guess they're in telecom nominally. Yeah. So, but they're also, Comcast is a little bit like if you stuck Netflix and AT&T and some other things kind of all together. You would get Comcast. It's kind of interesting. And yeah, that stock chart doesn't look great. Again, right? Like it ran way up really fast and now it's come down. It's hard to say if that is further down than it should be. It pays a decent dividend. Mark says he bought it at 35. It's at 38 now. So you're still up, which is good. So the thing is, I don't think Comcast is going away. Right? Comcast is in an interesting spot right now. I think we had a little bit of a sort of, let's call it a television bubble. If you want to go look at the price of, say, Netflix, which is somewhat similar to Comcast sort of media arm, it's not where it was not that long ago. A lot of other, WBD hasn't been around as long, but it's also, some of this is people worried about recessions. Some of this is in sympathy with Netflix because Netflix's earnings weren't very good. But it's pretty ugly in the streaming television space. Partially because, like I said earlier, things tend to run up real high and then come back down, and the correct price is probably somewhere in the middle. And yeah, Comcast also has an old school cable television business. I think probably more and more of that is going to transition into streaming, or streaming subscriptions plus internet. Things like that. It's the change in business model there a little bit, and it'll be interesting to see how well they can keep up. The thing about Comcast is, in a lot of places, they're the only people that can provide, they're the only cable provider in most places. And while there is competition for cable television from like DirecTV or some satellite provider, there is not competition for high-speed internet in a lot of those places. A lot of times you have a choice between maybe the phone company and some kind of DSL service and Comcast, and Comcast is way faster than than DSL. So I think it's probably, pretty solid in terms of that, but is the current valuation justified? It's really hard to tell just because Comcast is like a weird media conglomerate. This isn't the Comcast chart. Yeah. All right. Yeah, I mean, market, it depends on why you bought it, right? If you bought it to hold it for 30 years, I think it'll probably be higher in 30 years. It may be 3 different companies in 30 years, but I think the net value of those assets will probably be higher. Yeah, I mean, if you bought it as a dividend buy, it pays a 2% dividend. You're not going to get much better than that. Too many other places right now, especially at the sort of risk of Comcast. So I wouldn't worry about it too much as far as that goes, right? Like dividends are kind of a long-term play. So yeah, I wouldn't worry about that too much. And yeah, for the record, Netflix didn't split. They reported terrible earnings, and that's why their chart looks like that. All right. So yeah, Ahmad says this option for Marvel. So Marvel, Ahmad, this is a covered call. It's not really a spread. If the option expires, worthless. Which it's a little bit out of the money right now. We just keep holding the stock, and we'll sell another call against it. It's no big deal. All right. Don says, can you give me your take on Rio? Rio is another miner. I think they also do some copper. Yeah, so apparently it's mostly iron, but also a bunch of other stuff. Yeah, I tend to think commodities are, the thing about commodities is they're volatile, right? What tends to happen is the price gets high and a lot of people are like, oh man, the price for this is really high. We need to get as much of it as we can out of the ground. And so then the market gets flooded and the price goes down. And then some people are like, what are we doing? We can't sell it at this price. It's too low. So commodity stocks go up and down. If you look at Rio over time, it goes up and down, but it's, on net higher than it has been, except for, at the peak of the housing boom. But I think the company there's been some mergers and other stuff in here since then. So it's a little bit different company now than it was then. But yeah, I mean, it pays an 8% dividend. Obviously that dividend on something like this is going to move around a little bit. And it also depends on, your time horizon and some things like that. But in terms of a thing to have to just stick in a portfolio and have for a long time, it pays a solid dividend. I don't anticipate people are going to stop needing, iron, copper, and aluminum anytime soon. So, I mean, just generally, I think that kind of thing is fine. Again, will it be higher at the end of the year? I couldn't tell you. But as sort of a long-term play, I think things like that are probably pretty safe. It's probably not going to quadruple at in some short time frame, right? Like biotech stocks can do that. Rio won't do that, but it probably is a decent hold for a long-term investor anyway. All right, so Rick has a question here about speculation about the direction of the market for the balance of the year. Yeah, the shortest possible answer is, I don't have a year-end price target for any individual stock or the market overall. Stocks tend to go up over time is generally how I see it, and I think, that I tend to be skewed long in all of my everything. So that's kind of where I'm at. The economy seems relatively healthy, as I talked about earlier. Obviously there are, as he mentions in his question here, potential for some kind of war involving China. There's a war in Ukraine. There's other stuff like that. But yeah, I mean, barring some sort of, big shock from something like that, that's, surprising and even harder to predict than stock prices, it's hard to think of reasons for things to go down. Individual things may go down. I still think there's some froth in some of the, tech stuff and some of these other things that have come out in the last couple of years, just in terms of not really understanding why the prices are what they are. But yeah, I mean, that's the best I can do for you, really, is stocks mostly go up, and I don't see any real reason in the near term why they would go down, barring some sort of unforeseen event. So Mark says, anything on GM possibly going up? Yeah, GM, really, the legacy automakers are interesting. They just sort of keep getting whacked in the sense of, we had a pandemic. They started to recover from the pandemic, and then the supply chain crisis hit, and they basically couldn't make enough cars to sell. Which it turns out you can name your price, but what would be much better than naming your price is, just being able to sell as much of the thing as the market wants. And now they're trying to electrify. I think, yeah, GM and Ford, and to some extent Honda and Toyota are in kind of an interesting spot because they have massive supply networks, a lot of capital, things like that. And they've been making cars for a long time. They have dealer networks. They have a lot of advantages over the other car makers. I mean, if we want to look at some PE ratios, GM trades at 7 times forward earnings. Tesla trades at 102 times forward earnings. Most of the other car companies don't even have positive earnings, so you can't even calculate a PE ratio. It's hard for me to imagine a world where GM and Ford don't come to market with some electric cars and do relatively well. I mean, in terms of GM popping back to 50, that seems like kind of a big ask anytime soon, given that so GM actually cut their dividend at the beginning of the pandemic. And even though they've been profitable, they have not announced a return to paying the dividend. They have announced several times that they're increasing the amount of money they want to put into their electric vehicle thing. And so a lot of it seems to be about how well will that pay off? How fast can they get to scale at electric vehicles? Can they sell cars that people want at a margin that makes the company, as much money as selling gas-powered vehicles does? Yeah, that kind of question is impossible to answer. But I certainly like GM a lot more than some of these new car companies that haven't ever actually made a car, or have made 15 cars. All right, so Marlon says he's not sure how to use the Investors Observer system to make decisions. Marlon, it's pretty simple. What we have here is 7 scores. The overall score, I think, is a good starting point to look at sort of the health of a company and a stock. I don't know that it's what I would use to base any individual decision on. If you go back to what I was saying earlier about how to get started as an investor and needing to pick a strategy, once you have done that, then I think you can get into how some of these other things work, right? So like if you're a long-term investor, things like the fundamental score are going to be more important to you. This considers earnings and profitability and growth and what analysts think about the company, because they have some insights that we don't have. And so for long-term investors, I think you want to look at the fundamental score, the analyst ranking, the valuation score, things like that. For short-term investors, people who are day trading or doing some swing trading or something like that, well, you don't care what the company's earnings are, right? Like, say, all right, well, if the line gets to here, it's going to turn around and start going back up. Well, then what you care about is things like sentiment and the short-term technical score. Those are what you want to use for swing trading, momentum trading, something like that. But yeah, if you look at the site and you click on a score for a stock, it explains why it's there. It explains who it matters to. Also in our help center, at least in the glossary, we have, or here, yeah, we actually have this quiz that will help you figure out what kind of investor you are, and will tell you, which scores you should pay attention to. So that's probably a good place to start also. William says, do you think Elon will follow through with Twitter? It's less a question of following through at this point. He signed a contract to buy Twitter. It's really more a question of how is the court case going to play out. And yeah, I'm not an attorney. I'm certainly not a chancery judge. I don't know what the good options are there. My guess is the best outcome for everybody is Elon goes through with buying Twitter at a slightly lower price. I can't imagine a judge saying, hey, buddy, you got to buy this company you no longer want to buy. That doesn't seem like it's good for Elon. It also doesn't seem like it's good for Twitter. And I can't imagine a judge saying, like, yeah, you signed a contract, but whatever, and just letting him walk either. But I have no idea. I have no real insight into how that works. Let's see. Aziz says, what is the outlook on insurance companies like AIG? AIG in particular is kind of a weird one just because it's a much smaller company than it used to be. This is one of those charts that you look at and you're like, whoa, that was crazy. Yeah, obviously the stock price is lower. It also sold off a lot of operations after being at the center of the financial crisis. So the stock is lower, and it is also a much smaller company than it used to be. Insurance companies are kind of interesting, right? Like they tend to do relatively well in a growing economy, right? Like, more people doing things and needing to have those things insured. They also tend to do a little bit better when interest rates are higher. So that's probably better for them sort of over the longer term. In the short term, I don't think anybody knows what the Fed is going to do at their next meeting. That's probably the next big driver for AIG's stock in particular. But the short terms is always the hardest to see. All right, so Willett says, what happened to Target today? I don't actually know. It seems to be up. Yeah, there may have been some news here. It looks like it got a couple of upgrades recently. It doesn't seem like much else happened to it today other than just it went up. Probably the CPI report. One thing you can do is look at similar stocks and see if they all did a similar thing. Well, Walmart didn't. Macy's. Yeah, Macy's was up even more. So it seems likely it was something sort of across the retail sector that pushed it higher. All right, last question from Mark is, any guesses for BTU from now to year end? I think BTU is one of those coal companies. Yeah, Peabody. Yeah, no, not really. The coal has been relatively, it's been near the top of that sector and industry lists for weeks and weeks now. I don't have a good handle on how long the coal industry is going to stay strong. It seems likely for a while. I think the big threat to coal prices is obviously over a longer term, some additional carbon regulations, over the shorter term, some resolution to the war between Russia and Ukraine, and natural gas flowing out of Russia again. And I certainly don't have any guesses there. It doesn't seem like Russia is ready to stop yet. So BTU might do okay for a while. But yeah, it's hard to tell. Most of these companies, I think coal generally is probably a little bit like tobacco companies, only BTU isn't paying a dividend here. In the sense that it doesn't seem like an industry where there's a lot of room for much growth. Because China's building new coal plants, but they have a lot of coal domestically, so I don't know how much they're going to import. They also import a lot from Australia. So it's hard to know. It's hard to see a lot of growth for the coal industry in the future. Yeah. All right. Okay. All right. One more question from Frank, and then this is the last question. Before I buy a stock, what would confirm or nix the purchase according to Investors Observer? Frank, it depends on that strategy, right? Like, why are you buying the stock? Are you buying the stock because you think it's going to go up tomorrow? Look at the sentiment score, look at the short-term technical score. Are you buying the stock because you think it'll be worth a lot in 30 years when you retire? Ignore the sentiment score, look at the fundamental score. We also have this really nice news feed here. You can also look at that and see what's been going on with the stock recently. That's the thing that I tend to do also, right? If the stock looks nice to you, but analysts are downgrading it across the board, that might be a thing to wonder about. All right. Okay. All right. This is really the last question from Willett again. When we send out a buy rating, when would you buy in and how long would you put your options out? Yeah, we don't send out buy ratings. We send out specific trade ideas, and they have the expiration and everything else. And most of our trade ideas that we send out are designed to be held through expiration, right? They're credit spreads, the options expire and you win, or they're covered calls, the option gets assigned and you win. The diagonal spreads, we send those out in the portfolios. We will send you an email of when to close those up. But yeah, basically you're just trying to close it before expiration at something close to the difference in the strike prices. All right, that's really it now. Thank you all for coming. Thank you for subscribing to Investors Observer. I will talk to you again in 3 weeks. Thank you.